Okay, let's start the session now. Fine. So today we're going to discuss audit risk. We're going to discuss audit risk in our TRG session. I think in my theory class, revision class also we discussed audit risk, but anyway, it's important. We'll discuss some questions to understand or familiarize ourselves. Okay, fine. So first of all, I'll share the material here with you all in the chat. And also I'll share the material in the group also, TRG group. Okay, I'm sharing this material to you. Can you please check whether you received it or not? Can you please check whether you received this material? Whether you received it or not? Fine. So let's look at audit risk. If I take this concept called audit risk, it's definitely tested in your exams. It can be tested for 20 marks minimum. It can be tested from 20 marks to maximum 30 marks also, it is possible. Fine. Group, after the class, I'll share. In the group, I'll share after the class both risk TRG tube and also the answers. Fine. Both I'll share in the group. Okay. So if I take these auditor students, like it can be tested for 20 marks minimum. And some past papers can be tested for 30 marks also. Therefore, if I take audit risk, Section A questions possible, objective test questions. Section B questions, they might give a scenario and they can ask you to identify audit risk and response to audit risk. Probably Section B, question number 2. There's a high chance your second question, section B, question number 2, there is a high chance you will get this question. You will get this question. 1 minute. So there is a high chance that you will get question number 2, section B. If it is tested question number 2, maximum marks 20 marks. But there is a possibility that examiner can test this for section B, question number 1. Suppose if it is tested as question number 1, this can be tested for 30 marks also. There is a possibility this can be tested for how many marks? Total 30 marks. So in the revision class also, I explained to you all, when you get scenario, identify audit risk and response to audit risk questions, first of all, include a misstatement or possible mistake. That include a misstatement or else a possible misstatement. What is misstatement? Non-compliance with the standard, because it comes under inherent risk we discussed. Theory we discussed already. Or it can be a possible misstatement. Possible misstatement means that is not prohibited by the standard, but when you are trying to comply with that requirement, there is a possibility of mistake. So these are the two issues generally given in your case study. So when you read your case study, yes, there is a possible misstatement or there is a confirmed misstatement. Some misstatement, they might say like, okay, non-compliance with standard. Some misstatements like there is a possibility of non-compliance. So if I take here, most of these problems, either misstatements or like possible misstatements, everything is related to financial statements, not related to entity. That's how the business risk is different from audit risk. So if you choose advanced audit and assurance, I'll teach you business risk. So most of the students, they should understand that sometimes when they are writing answers, they are writing answers organization perspective. Examiner clearly told Students should not write business risk instead of what? Audit risk. Students should not write business risk instead of audit risk. Audit risk is the risk arise in the financial statement, the subject matter. So that is why we are telling like client side reason and auditor side reason. Client side reasons we call risk of material misstatement. Auditor side reasons we call detection risk. So everything that is simply it's related to financial statement, not related to entity. Suppose if you are writing answers by connecting it to an entity, that become a business risk. That become a business risk. It is not related to what? Financial audit risk. So financial statement, don't forget. So always these problems are related to financial statement. That is important. And mostly that is 90% of your answer or a case study, inherent risk on. If you take your questions, 90% of your problems are what? Inherent risk only. So 90% of the problem I said inherent risk. Most of the time it is complexity in the nature or complexity in the transaction. Transaction become complex because of two reasons. What? Assertion and not standard. If you are not complying with standard, that is also complexity in transaction. If you are not complying with assertion problem, that is also complexity in the transaction. So complexity in the transaction due to assertion non-compliance or standard non-compliance. That we should understand, right? So this is the second type of question. Third type of question is like they might give you a scenario. That scenario also include possible and confirmed misstatements. And along with the scenario, they will give you financial statement extract. A part of financial statement, a portion of financial statements. It can be a extract or portion of income statement. It can be a portion of balance sheet. So financial statement extract is also given. Scenario and financial statement extract is also given. Based on the financial statement extract, because if you look at income statement extract or balance sheet extract, it is not providing information. Whatever the data available in those financial statements, we should apply analytical review procedure and we should form an information. Those data need to be analyzed. That's why you might study financial statement analysis in your SPR paper or in your FR paper, where we use ratios to ratio analysis in order to take decisions, because ratio analysis help us to analyze financial information. So such kind of an analysis is required. In audit terms, we call that as what? Analytical review procedures. So if the financial statement extract is given directly, we can't identify audit risk. For that, what we do is we perform analytical review procedures. So analytical review procedures are ISA 520, and already we studied ISA 520 in detail. There are different methods we use. When it comes to this particular ARP. So we can compare current year figure with previous year figure. We can compare current year figure with budgeted figure. We can compare current year figure with industry figure. So all these cases, what we're going to do is we should perform ARP, and from this ARP also we can identify audit risk. And they gave a scenario. From that scenario also we can identify audit risk. Therefore, we should identify audit risk from both scenario and ARP. From both scenario and ARP. Then we should respond to risk. So these are the two types of case study questions. Either scenario identify audit risk and response risks, or a scenario financial statement extract identify audit. If we need to perform ARP, then we need to identify audit risk and response to audit risk. So these are the possible combinations of questions when it comes to audit risk. Is that clear? Copy this. Copy this. This time I'm expecting scenario identify audit risk and response to audit risk. But anyway, it's better to prepare for all three. Better to prepare for second one and third one. Copy this. Right. Now, already we discussed in the class also how to write answers. Simply, if the risk is inherent risk, either standard complication or assertion complication, first we need to identify the issue. Second, we need to explain the assertion. If it is assertion problem, we should explain the standard. It is a standard problem. Then we need to write the impact to financial statement, how it's going to affect balance sheet, how it's affect income statement, right? And when it comes to control risk or detection risk, or inherent risk by nature, complexity in the nature, then identify the issue and impact to financial statement and procedure to reduce the risk to acceptable level. What sort of audit procedures we can do, that we have to write it here. So that is how we should approach these audit risk questions. Now, students, right. I gave a question. 1 minute. Right. Here, this is the question. See, this is second type of question format. They gave a case study. They gave a case study, and what they did was like they asked us to identify the audit risk and response to audit risk. Identify the audit risk and response to audit risk. See, if you look at this question, you are the audit supervisor of STC, planning the audit of your client as manufactures cleaning products. Its year end was 31st July 2006. That is my cutoff point. And the draft profit before tax is 33.6 billion. You are supervising large audit firm first time and have specific responsibility for supervising and reviewing the work of audit assistants in your audit team. Right. So if you look at here, there is a quality issue because the first time you are going to supervise the team. So by that, the competency level is very low. So the transaction become more, sorry, the nature is more complex. So inherent risk is also there. And also there is, to some extent, I can argue with the detection risk also. The person is first time handling this audit. So there is a possibility they might not detect material misstatements. S company purchased most of its raw materials from suppliers in Africa. And these goods are shipped directly to the company warehouse. And the goods are usually in transit for the period of 3 weeks. So when goods are in transit, it can be a cutoff problem. But why I'm telling it is a cutoff issue? Because we ordered at one point and after 3 weeks only we are receiving the goods. At which point we recognize purchase. Whether at the time of placing order we recognize purchase, or whether the same goods are sent by them at that point, whether we are recognize the purchase. So where we recognize the purchase, that is the problem here. That is a cutoff issue. By that your inventory, sorry, your purchases may be over understated, misstated. So the company, so we should talk to management as a response. We should talk to management and see how they're going to recognize their purchase. And that should be assessed by the auditor to check whether it is in line with the reporting framework or not. Third paragraph, the company has incurred 1.3 million expenditure developing new range of cleaning products which are due to be launched the market in 2006. In September 2005, S company is also invested 0.9 million in a complex piece of plant and machinery as a part of development process. The full amount has been capitalized, and that is include installation cost and training cost. Actually, here if you look at this 1.3 million incurred for developing new product. So when we are talking about development cost, there may be some research cost because the breakdown of 1.3 million is not given. So this 1.2 million comprises what type of expenditures? I don't know. This 1.3 million comprises what type of expenses? I don't know. Therefore, the breakdown of these 1.3 million is important. And I should see the nature of the expenditures. Whether such expenses are capital in nature or whether such expenses are revenue based. Right? So if it is a revenue based one or recurring expenditure, you can't recognize in the financial position. If you are doing that, your assets are overstated and your profits are overstated. So So you should talk to the management and get the breakdown of this 1.2 million, and you should investigate the nature of it. And 0.9 million property, plant and equipment, what they did was they include installation cost and training cost also. So as per IAS 16 property, plant and equipment, it's clearly said what sort of cost can be included. Within the cost of property, plant and equipment. So the training cost and all, you cannot recognize, right? So by that, what happened was your asset is overstated. By that, your asset is overstated. That is the problem here. So next one, if I move. So if you look at these things, right? See, the first one is cut off. It is complex transaction. Second one is IAS 38. That is also complex transaction standard. Third one is IAS 16 property, plant and equipment. That is also a standard problem. And also when you are taking this, another issue you can argue here, when you are taking a training cost also into the cost, your cost is overstated. Suppose if your cost is overstated, what will happen to your depreciation? Because you all know the depreciation is calculated based on the cost, right? So either a direct method or a straight line method or reducing balance method. We are taking the depreciation or we are calculating the depreciation based on what? The cost. Therefore, when you are taking this training cost into assets, training cost also included within assets cost, that will affect our depreciation as well, right? So next paragraph, see here, this year the bonus scheme of senior management and directors has changed. So rather than focusing on profit, they are trying to focus on the assets. So actually it comes under the manipulation. I could say it's a control risk. So the control environment is weak. That's why they changed from the profit to asset. So when they recognized a bonus is based on asset, when they are recognizing bonus, sir, is it also column answer scenario? Yes, yes, yes. You should write column, one side audit risk, the other side response, right? So manipulation is there. So there is a chance assets get overstated. If you look at all the previous examples, case examples, actually what happened was they didn't charge they charge training cost to property, plant and equipment, assets is overstated. Entire cost related to the development is capitalized. By that also asset is overstated. So what I'm trying to tell you is there's a high chance they are trying to boost or they are trying to overstate the asset value, right? So that is subject to risk of manipulation, right? So auditor as a response, we should increase our skepticism mindset and we should increase our apply of professional judgment over the subjective areas, estimated areas. And also, you know, when it comes to manipulation, it is a fraud. So this particular change, I can say they are changing from profit to asset. So this change shows like they can do fraud. You all know under ISA 240 standard planning we studied, under ISA 240 standard, what is fraud? Actually, the concept of fraud, if you take, it is management have primary responsibility to create an environment which is free from fraud. So management need to create an environment to confirm that environment is free from fraud. So if you look at here, fraud can be like defined in two ways as per the standard ISA 240. One is manipulation or manipulation of financial statements and misappropriation of assets. Manipulation of financial statements and misappropriation of assets. So here, if I look at, if they change the bonus computation based on total assets, it's like it will lead to manipulation of financial statements. That is a part of fraud. So, how management can meet their responsibility in terms of fraud environment by creating a strong culture and the controls. So what I should do is, as a response, we should apply professional skepticism and professional judgment throughout the judgmental area Because if management wants to do fraud or management wants to manipulate financial statement, the best place to manipulate or best area to manipulate this financial statement is, I can say, like judgmental areas. So judgmental areas only they can manipulate. Therefore, we should always apply professional skepticism over those judgmental areas. So the next point here, see, in previous years, that is also control risk, manipulation. This bonus type of questions are case studies are repeatedly tested in your past paper, right? So bonus scheme is changed. Bonus is based on profit before tax. Bonus is based on the sales. Bonus is based on the total assets. All these are leading to a manipulation. All these things are leading to a manipulation. When management is developing a policy that bonus is based on these factors, that is subject to manipulation, right? And also in previous years, an allowance for receivable. You all know allowance for receivable is IAS 37, IAS 37 provision. Allowance for receivable is a provision. See, a previous year's allowance for receivable made up with specific balances in which equaled almost 1% of the trade receivables. So what they did was, generally they maintain 1% of allowance for receivables. However, the finance director feels that this is excessive and unnecessary, and therefore not included it in the 2006 financial statements. So if you look at here, one thing that we need to apply our skepticism and judgment to identify the possible issue here. Actually, they are introducing a bonus based on the asset. They are introducing a bonus based on the asset. So asset include current asset and non-current asset. So non-current asset also they are trying to boost in different ways. Current asset also they are trying to boost different ways. How to overstate current asset, especially receivable, not charging allowance for receivable. If we charge allowance for receivable, our net receivable will be reduced. But if you are not charging allowance for receivable, our net receivable will increase. If our net receivable is increasing, our current asset will increase. If our current asset is increasing, our total assets will increase. Therefore, their bonus is based on the total assets. That's why they are trying to remove allowance for receivable, right? So that we need to understand. So this is IAS 37 standard clearly said, present obligation arise from the past event, future economic benefit outflow is probable, cost is measurable. If the conditions are satisfied, charge provision. Double entry is expense account debit, provision account credit. So that is the problem here that is related to IAS 37. Next paragraph. So IAS 37 related problem is also, it's an inherent risk. The next paragraph, a new general ledger system was introduced in 2016. New general ledger system was introduced in 2016. The finance director has stated that the data was transferred and old and new systems were run parallel. So when you are running new system and old system to parallelly, there is a possibility of what? The controls are need to be effective, right? If the controls are not effective at that stage, that will result duplication and more errors in the financial statement. Duplication and more errors in the financial statement. By that, your financial statement may be materially misstated. It's a control risk. As a result of the additional workload of finance team, the number of control account reconciliations were not performed, including bank reconciliation. So this is also a control. So if you look at in this question, there are a few control risk is also given. So the company is not performing bank reconciliation statement and control account reconciliation. This shows their internal control is weak or absence of internal control. By that, your financial statements are subject to misstatement, especially from purchases, receivables, cash and bank expenses. All these are subject to misstatements in this case. And also as a response, we should talk to the management and see why they are not performing good. And we can request management before we commence audit, immediately reconcile up to December and give it to us. So that is a response that we can give it to here. And also the finance director is comfortable with this. These reconciliations were successfully did for both June and August. In addition, the year-end closed down purchase ledger is undertaken 8th of August. Actually, purchase ledger, if you look at 31st of September means 31st of September, it should be brought forward next balance to the next year because it's next year's transaction after that. But here what what we did was, due to staff constraint, we decided to close the ledger, purchase ledger by 8th of August. Actually, if you close 8th of August, that purchase ledger, your purchases are overstated. Your purchases are overstated. You got my point? That is what cutoff problem means. So this is the explanation for this audit risk. Anyway, I'll give you answer. Right here, see, the answers are given. Just go through with this answer. Right, later. Whatever I explained is there. Right, now let's move to this question. Students, right, question number 2. If I take question number 2, that is also audit risk question. But this audit risk question consists somewhat financial statement information. Now today, actually I told you my theory class, I'll do it. That Saturday I'll do a ratio question. So we have time, so we can do it today itself. So Saturday, our revision class, we can take it a complete different paper, right? So now students, I'll give you 5 minutes time. First calculate 5 ratios. Why? Because ratios are, I can say ratios are what? ARP. Calculate 5 ratios. Don't forget this thing. Sometime in your exam paper, this is when you get a question, audit risk question. In that audit risk question, if they mentioned an extract of financial statement, given means you should understand one thing. That is, if you got an extract of financial statement within your audit risk question, that is an ARP question. That is not a normal question. Normal question only we discuss now. So if you get a financial statement extract, definitely it is an ARP question. When you are doing ARP question, students, I'll tell you, some past papers, they might ask you to identify 2 ratios, 3 ratios, 4 ratios, sometimes 5 ratios, right? But even they said 2 ratios or 5 ratios or 1 ratio, you should calculate these 4 types of ratios. It is very important. Profitability ratio calculate. Don't calculate all the ratios in the profitability. Can be gross profit margin or operating profit margin or ROCE or whatever. Liquidity ratio, current ratio and quick ratio. Efficiency ratio, don't forget. Because efficiency ratio is very, 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 very important. Because efficiency ratio is going to give us more information. Finally, debt ratios. These are the 4 types of ratios we should calculate. Now concentrate. I'll give time to copy. Wait. See here. When we are talking about efficiency ratio, there are 3 types of efficiency ratio. 1 is receivable days, 2 is payable days, 3 is inventory days. What are the 3 efficiency ratio? Receivable days, 2 is payable days, 3 is inventory days. If we calculate receivable days link with credit risk. For example, let's say last year when I'm calculating receivable day, 52 days. This year when I'm calculating receivable days, 82 days. What it means? Receivable days are increasing. Receivable days increasing means unable to collect money soon. That means credit risk. You should understand that. If receivable days are increasing means credit risk is increasing. If receivable days are decreasing means credit risk is decreasing. At the same time, if you look at the payable days are increasing means it's an indication of going concern. It is not a good sign. Payable days are increasing means you are unable to make the payment to your supplier. That's an indicator of going concern. Third one is inventory days. Yes, we should increase the provision. Try to understand these relationships, right? Then I'll tell you how to approach with the question. Okay. Still, I didn't read the question, but I'm just explaining. This is common for all the cases. If the receivable days are increasing, credit risk is increased. Therefore, the credit risk increase means provision to be increased, or else you should write off bad debt. Payable days are increasing means going concern indicator. Inventory days are increasing means like last year inventory days 50 days, this year inventory days 100 days, which means last year within 50 days our finished good is converted into sales. This year it take 100 days to convert our finished good into sales. So when your inventory days are increasing, there is a high chance our inventory is not moving. Our finished goods are not get sold, right? So our inventory, that finished good are not get sold. So it takes time to sell our finished good. So when it will take more time to sell our finished good, what is the indicator? There is an NRV issue. Because if you keep the finished good without selling for a long period, sometime you might not able to sell at the market price. So there is a possibility your cost will be lesser than your NRV. That is we call net realizable value. Sometimes your net realizable value might be lesser than cost. That is we call NRV issue. So try to understand when receivable days are increasing, it's a credit risk, right? When payable days are increasing, it's a going concern problem. When inventory days are increasing, it's an NRV issue. And also all other ratios, profitability, liquidity, and debt, if it is not performing well, it's an indicator of going concern. This understanding is very important because with this understanding only, we're going to correlate with the case study. We're going to correlate with the case study. Therefore, in your exercise book, students, put a subheading, question number 2, TRG. TRG question number 2, put a subheading. Put a subheading. ARP with audit risk. ARP with audit risk. Right? Under that, write it down. Following ratios need to be calculated. Following ratios need to be calculated when auditor assessing audit risk through ARP. When auditor assessing audit risk through ARP. Under that, copy this. Mark it as very, very important. Copy this. Copy this relationship. Right. I hope you all copy. Now, from the information, they ask us to calculate 5 ratios for both years, for 2 years. Now, let's move to the question. See here, the information is provided for 2012 and 2013. For both 2012 and 2013, calculate profitability, liquidity, efficiency ratios. Do it. I'll give 5 minutes time. First calculate the ratios. Then we can, that is how you should approach the question. If it is an ARP question, first of all, calculate ratio. Don't read the scenario even. First read the calculate the ratios. Calculate. So you can calculate gross profit margin, current quick ratio, receivable days, payable days, and inventory days, debt ratio. Do it. I'll give 5 minutes. Calculate those ratios. Right, now let's see. So they haven't given equity details. So you should calculate backwards to equity amount to calculate debt ratio. If they didn't give equity, don't need to calculate debt ratios. Right. Don't think too much. Like it's not a FR, like the information is not provided, ignore. Fine. No need. Because they didn't specifically ask us to calculate specific ratios. Right. So whatever we can just calculate. If the information is provided, just calculate that also. Right. But don't forget to calculate efficiency ratio. I'm not bothering much about other ratios. My concern is only efficiency ratio most of the time. Right. So now let's move to the ratios. So if I take gross profit margin, 46.7% last year, 44% this year. Operating profit margin, 12.7% last year, 4% this year. So in both cases, profitability is reduced. Inventory days, 64 days last year, 99 days this year. That means inventory days are increasing. What it means? We are unable to sell our finished good with a short period of time. And receivable days, if I take 49 days become 91 days, that is also receivable days are increasing. It shows credit risk. Payable days, again 55 days become 83 days. That is also indicating that entity is struggling to make the payment. It's an indicator of going concern. Okay. Current ratio decreased by 50%, like 4.4 times become to 2.2. That is also an indicator of what? Going concern. Quick ratio is also 3.3 become 1.5. Right. That is also significantly reduced. That is also half of that reduced here. So these are the points that we can calculate through the ratio analysis. So first step is what? We should calculate the ratios. Copy these ratios, then we'll move to the second step. First step is what? Calculate ratios. Don't read scenario, no need. First calculate ratios. Then we'll move to the second step, right? First copy this answer. Ratios first copy in your exercise book. So I hope you all copied the ratios. Now let's look at the second step. First step is calculating the ratios. The second step is you should read the scenario. So let's read the scenario here. You are the audit senior of Rhino and Company. You are planning the audit of Kangaroo Construction for the year ended 31st March 2013. Kangaroo specializes in building houses and provides a 5-year building warranty to its customers. Your audit manager has held a planning meeting with the finance director. He has provided you with the following notes of his meetings and financial statement extracts. Kangaroo had a difficult year. A house price has fallen. As a result, revenue has dropped. In order to address this, management has offered significantly extended credit terms to their customers. See here, already we performed what? Already we performed ARP. In our ARP, analytical review procedure, right? We find out our receivables are like receivable days are increasing. What happened to our receivable days? Receivable days are significantly increasing. So receivable days increase means what happened? Obviously, the credit risk will increase. Obviously, the credit risk will increase. So receivable days increasing means credit risk increase. And also from the scenario, they said management has offered significantly extended credit terms to their customers. Both are interconnected, right? So when management is giving extended credit terms to their customers, credit risk will increase. The same time, we find out from our ARP that receivable days are significantly increasing. Both are telling the same problem. Both are telling the same problem. When both are telling same problem, it's our duty to take both together. It's our duty to take both together. Therefore, students, take the credit risk. That is the only judgment we should apply here. So only that judgment only we should apply here. What is that judgment? Whatever the matters given in the scenario and whatever the conclusions that we reach from our analytical review procedures working, both should be merged together. Both should be merged together. So you can't write this particular problem separately as a credit risk and the ARP calculation receivables are increasing, that as a separate credit risk. You can't take it as two different risks. Both should be merged together. That is the only difficult point that we need to understand here. So both case study issue, both ARP issue, if this both issues are talking the same problem, both issues are talking the same problem, we should merge both together. We should merge both together. So here, management is offered extended credit terms. Please mention that in when you are writing answer. When you are writing answer, first of all, I told you, you should explain the key issue, right? So when you are explaining key issue, take this one. Management has offered significantly extended credit terms to their customers. Then take ARP. As per the receivable days computation, that is increased from this number of days to this number of days. That is the issue. How to take the issue? Both should be worded together. Then we can write in the same way answers. Then we can write in the same way. See here, if I look at the solution, receivable days increased from 49 days to 91 days. That is from ARP. And management has significantly extended the credit terms. Management has significantly extended what? The credit terms. So receivable days also increased. Management also significantly extended the credit terms given to customer. This leads to increase the risk of recoverability of receivable. By that, what happened? Your receivables are overstated. By that, what happened? Simply the receivables are overstated. So for the receivables overstated mean what is the response? We should perform extended post-year-end cash receipt test. That won't change. So when it comes to this overstatement of receivables, credit risk, we should perform post-year end cash receipt test. We should perform post-year end cash receipt test, right? Now, students, let's move to the story. That is the only thing. You can't take credit risk separately, and you can't take but ARP risk separately. Both should be taken together. Okay. So now first copy this audit risk, first one that we discussed now. Copy this one. Then we can move to the next point or scenario. Copy this. So here, that is the only point where we are merging. See here, receivable days have increased from 49 to 91 days that I took from the ARP, and management has significantly extended the credit term that is I took from the scenario. Both will increase the risk, recoverability, credit risk. By that, receivables overstated, the response is extended post-year and cash receipt test. This post-year and cash receipt test is common for credit risk. Okay, copy this answer. That is the only point where we are going to merge. That is the only point where we are going to merge. So only the difficult portion is if the same problem is explained by ARP, the same problem is explained by the scenario, you can't write it as a two different auditors. You should merge both together. You should merge both together, right? Copy this answer. Copy this answer. Okay, now let's move to the case study again. Now let's move to the case study again. See here. If I go to the case here, however, the demand fallen such that there are still some completed houses in inventory where the selling price may be below cost. It's a construction company. It's a construction company. For a construction company, houses are like finished good. It comes under inventory. You got my point. For a car sale, uh, the cars available for sale is a finished good. Likewise, for a construction company, completed house is a finished good. That is comes under the inventory. Actually, what happens? The inventory finished good prices are below cost. So they are talking about NRV issue. There is a possibility the cost of the houses may higher than its NRV. The net realizable value of the house is lesser than what? Cost. That is what they are telling here. The same issue we discovered in our ARP also. The same issue we discovered in our ARP. See inventory days, 64 days. Now it's become 99 days. So when my inventory days are increasing from 64 days to 99 days, when my inventory days are increasing from 64 days to 99 days, it shows NRV issue. My net realizable value might be lesser than cost. The same problem is repeatedly mentioned in the scenario also. Again, it is also like two different areas we identify the same problem. From ARP also we identified NRV issue. From the case study also they given NRV issue. So now we can merge both together when we are writing answer. Now see here. Due to fall in the demand for Kangaroo construction company houses, there are some houses where the selling price may be below cost. IAS2 inventory standard require that inventory should recognize cost to NRV whichever is lower. In addition, see now I am taking AR. In addition, inventory days have increased from 64 days to 99 days. Right, but it shows that inventory is overstated. Inventory is overstated. So what I should do is when there is an inventory related problems, NRV issue, we should perform a detailed cost and NRV test. We should perform a detailed cost and NRV test. Copy this now. I hope you will understood. So one problem is identified by the ARP. The same problem is identified by the case study. I merge both together when I am writing audit risk. Okay. Copy this. This is a second audit risk. Now let's move to the question again. Now let's move to the question again. Here, see. During the year, while calculating depreciation, the directors extended the useful life of plant and machinery from 3 years to 5 years. This reduced annual depreciation charge. So when directors are extending the useful life of the plant and machinery from 3 to 5 years, actually the depreciation charge will reduce. On the other side, what will happen to profit? Profit will increase. But if you look at standard perspective, it is permitted because the useful life is an estimate. So IAS 8 standard, it is permitted us to change the estimates. And also IAS 16 property plant and equipment standard is also permitted to revise depreciation or revise useful life. And once it is revised, depreciation need to be calculated based on the new useful life. So what I'm trying to tell you is, this is a non-compliance with the standard when it comes to here, right? But standard said, it is not blankly allow directors to revise useful life. The standard said, yes, it is permitted to revise useful life. What is the reason? There should be a rationale for that revision. There should be a rationale for such revision. So when there is a rationale for that revision, rationale means there is a reliable measure, there is a reasonable fact to revise the useful life. For example, if I take, there was an AC machine. Initially, at the time of purchasing that machine, we decided, okay, useful life will be 5 years. So after that, we changed outdoor unit. After 3 years, we are changing outdoor unit. You might heard what is outdoor unit. So after 3 years, we are changing outdoor unit. Once the outdoor unit is changed, obviously my useful life will increase. Yes or no? Obviously my useful life will increase. So that is one rational reason to revise useful life. Simply you can't just revise the useful life. So now what is the risk here? There is a possible risk. There is a possible risk that management might revise useful life in order to overstate what? Profit. In order to overstate assets. So in order to overstate assets and profit, management might revise useful life. That is also one reason when we can think. If that is the case, financial statements are mistaken. So that we need to check. If you take this problem, this is not a problem only comes from the problem which comes from ARP. No, from ARP we couldn't find this. This is found through our scenario. Therefore, directly we can write. Okay, so let's take a possible misstatement here. Let's take that into our answer. See, the directors have extended useful life. The directors have extended useful life of plant and machinery from 3 years to 5 years, which resulting the depreciation charge is reducing. Under IAS 16 property, plant and equipment, useful lives are to be reviewed annually. And if the asset lives have genuinely increased, then this change is reasonable. So it is permitted if it is genuinely increased. However, there is a risk that this reduction has occurred in order to achieve profit targets. Because in order to boost your profit, if they did this, it is a misstatement. If that is the case, then plant and machinery is overstated, profit overstated. So actually we need to discuss with the directors what is the rationale behind, extending useful life. Why they extended useful life, what is the reason or what is the rationale behind this extension that we need to discuss. So that is the audit risk and the respects. So it is a possible misstatement under IAS 16 and IAS 8. Copy this. Copy this. Right. Now let's move to the case study again. Now let's move to the case study again. If we go to this case again, see here. The directors need to meet the target profit before interest and taxation 0.5 million in order to be paid their annual bonus. Right. See, they have a profit target. So if they want to get a bonus, they should meet minimum 0.5 million profit. It's a control risk. See, this might result a person to manipulate financial statement because self-interested, right? To manipulate financial statement in order to achieve the bonus. Therefore, financial statements are subject to what? Misstatements. There are a lot of manipulation. There are a lot of manipulations possible in this regard. So, auditor, I should perform procedures like skepticism mindset. I should perform procedures with the skepticism mindset, and I should be aware about this. Right. So, here see, that is also only from the case study, not from the ARP. See here, this one. The directors need to reach profit level of 0.5 million in order to receive their annual bonus. There is a risk that they might feel under pressure to manipulate the results through the judgments taken or through the provision. So especially the judgmental areas, estimated areas, they are fully focusing on those areas in order to manipulate the financial statement to achieve their profit targets, target profits. So audit risk is very high in this our case, right? So throughout the audit, the team need to be alert and maintain the professional skepticism and professional judgment. And we should carefully perform procedures over judgmental areas. We should carefully perform procedures over what areas? Judgmental areas. That will be the response in this case. So it is a risk subject to manipulation in terms of like to meet the profit target here. And also they said, in addition, try to improve profits. Apart from this, in order to improve profits, Kangaroo changed their main material supplier to cheaper alternative. So when a company is changing a main supplier to a cheaper alternative, right? When there is when we are changing a cheaper alternative, the quality of the product get reduced, right? When quality of the product is reduced, what is the impact? Sometimes the customer might file case against the organization. Returns may be increased. So warranty claims may be increased. So there is an obligation. There is an obligation. In that situation, we need to increase our provision. In that situation, we need to increase our provision. Level of provision need to be increased. If that provision not increased means what will happen? Your liabilities are understated. Your expense is understated. So that is the impact. So let's look at that, because when we are changing to the local supplier, a low quality supplier, a cheaper alternative, obviously the provision will increase. That is, we discussed under IAS 37. If the present obligation arises from the past event, future economic benefit outflow is probable, cost is measurable, we should recognize a provision. So in that case, yes, let's take that point here into our answer as the next one. If you look at this answer, see here, due to the change of material supply, the quality of the products used has deteriorated, and this has led to customers claiming on their 5-year building warranty. So building warranty claims will be increased. Building warranty claims will increase. If the total overall number of people claiming on the warranty is likely to increase, then the warranty provision should possibly high. If the directors have not increased the level of provision, then there is a risk that provision is understated, and along with that, expense is also understated. So actually, we should review the level of warranty provision recognized by the management, and we should see whether such provision is enough, or otherwise I can say whether such provision, completeness of the provision need to be assessed, whether such provision is complete or sufficient or not. So that is the response for that audit risk. Now, students, let's move to the story again. Case study. They gave that point here. To help operating cash flow, directors borrow 1 million from the bank. So normally when directors are borrowing 1 million from the bank, the due repayment date is end of 2013. So in the current year itself, we need to repay. In the current year itself, we need to repay that particular entire 1 million loan. So it creates two problems. One is whether this 1 million is recognized, classified properly or not. Because you all know under IAS 1 preparation and presentation of financial statement standard, the liabilities comes within 12 months should be recognized as a current liability. The liabilities more than 12 months should be recognized as non-current liability. So the loan that should be properly split among current and non-current liability. If not, it's a classification problem. Financial statements are misstated. What is the response? I should review financial statement to see whether the current and non-current liabilities are properly disclosed. Now, the second issue is if we going to repay this particular loan at once within the 12-month period, there is a going concern issue. And also, through our computation, ARP, if you looked at the profitability, gross profit margin reduce, operating profit margin reduce, payable days increase, current quick ratios are significantly reduced. All this shows this entity is facing significant doubt over going concern. There is a material uncertainty over going concern. That we need to understand. So if there is any material uncertainty over going concern, sufficient disclosures are need to be made. So here see, Kangaroo borrowed 1 million from the bank via short-term loan. Therefore, it should be recognized as current liability only. So this loan need to be repaid in 2013, should disclosed as a current liability. If not, it's a classification problem and financial statements misstated. And also, in addition, Kangaroo may given the bank a charge over the asset security for the loan. There is a risk that disclosure of security given is not complete. Correct. So if you are giving that security for that loan, yes, the risk that disclosure of any security may not be sufficient, complete. On the other side, if you look at the ratios are not performing well, we need to repay the loan. Altogether, if you look at everything, it shows going concern difficulties. So when there is a going concern difficulty, there should be sufficient disclosures are needed in the financial statement. If the sufficient disclosures are not made, financial statements are materially misstated. Right? So that is the answer. That is the answer for this question, right? So first copy these two. right? So that's all related to the audit risk portions, right? So again, I'm telling you, please go through with the examinable questions what we discussed, and please go through with the question structure and be prepared for your exam. So therefore, from today onwards, you need to practice questions as much as possible, right? So all these questions you should practice. Section A types of questions, practice. Section B, scenario, identify audit risk and response to audit risk. Scenario, financial statement extracts, perform ARP, and identify audit risk and response to audit risk. All these type of questions you need to perform, right? So our next TRG is next week. We'll meet at our next TRG. Thank you.